darker view is that the excess manipulation of money blows up the entire system. And that's a lot of people hold that view, that you end up with a hyperinflation or something of that sort, a total economic collapse. But I struggle to get to that answer because in every circumstance, when asset prices collapse or something goes wrong, they just print money. And when you're the world's reserve currency, it's bloody difficult to hyperinflate it. What you end up with is this ridiculous rise in asset prices, which then gets rid of this ability to have this massive downside.
The consistent devaluation of fiat currencies has resonated strongly with sound money enthusiasts, with many influential investors and speculators expressing concerns about an imminent collapse of the global monetary system. The prevailing sentiment among these advocates is that central banks' reliance on excessive money printing to address economic challenges is steering us towards a crisis. According to this perspective, even robust fiat currencies like the dollar may eventually lose significant value. Despite this prevailing narrative, a dissenting voice emerges in the form of Raoul Pal, the founder and CEO of Real Vision. Pal believes that the United States economy, backed by the strength of the US dollar as the world's reserve currency, has a substantial chance of not only surviving but thriving for several more decades. In his view, the ability to print money, a privilege associated with the US dollar, will persist for at least the next 7 years, providing a temporary solution until a more permanent one can be developed. Pal identifies demographic and productivity challenges as the root causes of the ongoing trend of money printing. Raoul Pal, a former executive at Goldman Sachs, contends that the US has the advantage of its currency being the world's reserve, allowing it the flexibility to print currency in times of crisis. He anticipates the continuation of this practice for the next 7 years until a comprehensive solution is devised to address underlying challenges such as demographics and productivity depletion. Pal's perspective challenges the prevalent notion of an imminent collapse, offering a unique and optimistic outlook on the long-term macroeconomic landscape.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The debt problem is really interesting. 2008, every major government in the world of a developed economy hit 100% of GDP in debt. So, okay, and interest rates, let's say 5-year interest rates where they generally finance themselves, have averaged around 2% or less. But so is economic growth. So if you think of GDP as all of the money circulating around to pay for the debt, there's no more money left over. But the problem is the private sector is over 100% of GDP in debt in every major country. So who pays for that debt? So that's when they started shoving the interest payment debt onto the balance sheets, because the world basically hit the tipping point in 2008, and people still haven't worked this out. But I think I was the first person, and still maybe the only person, who's gone back and calculated all of the interest payments and realized that they are, and the balance sheet growth, and realized that they are just 3.5 years apart, the same chart. They just keep monetizing it. And that's the way that they see out of the debt, is to mutualize those payments across everybody by increasing the balance sheet. But the debt doesn't go away because GDP is not growing fast enough. So you have to change the GDP formula. If not, you're in this endless trap where you're printing more and more money, making the rich richer, the poor poorer, ad infinitum. And I think that for individuals, as I said, there's only 2 assets that outperform this. That's technology and that's crypto. Okay, fine. The economy, that's really hard to get this to sort itself out. People are waiting for a collapse, the market's down 80%. It can't. The reason it can't is the central bank debased the currency and it makes the stock market go up optically, because they can't allow the collateral of the system to go bust. So they don't allow the system to go bust, and it creates this ongoing problem. But if you listen to the narratives from the central banks and the governments, what they're really saying is the whole green energy revolution. Europe is massively funding this. And yes, it's good for the planet. Yes, it's good for a number of things. But really what they're trying to do is lower the cost of electricity. Because if you lower the cost of electricity, it has this multiplier effect on productivity. And that's how you can grow GDP growth. The other thing is population. Well, we're shrinking populations, as I said, so we have to replace people. So look at Amazon warehouses. The growth is not in people. The growth is in the robots. The robots work 24/7, 365. They never complain, and they cost a fraction of a human. So every company is incentivized to employ robots to do jobs instead of humans. Then this year we had the nuclear bomb of deflation, which is human knowledge, lawyers, doctors, accountants, creative artists, developers, everybody, and they're replaceable via the infinite knowledge machine that is AI. That's scary for us as individuals, but if population growth is a large part of the components of GDP growth, you can create infinite people by the robots and AI.
Several significant examples bolster the theory proposed by Raoul Pal that increased productivity and economic expansion can effectively address the debt burden, allowing for a prolonged reliance on periodic money printing. Macro analysts like Pal and Lynn Alden frequently cite the example of globalization in the early 1980s to illustrate this point. During that period, when the United States faced a massive and widely debated national debt exceeding $1 trillion for the first time on October 22, 1981, globalization efforts played a pivotal role. The advent of technological advances, primarily reflecting globalization, made international transactions quicker and more accessible. According to the International Monetary Fund, the 1980s and 1990s marked decades of globalization, with the term becoming more commonly used during this period. China's adoption of its open-door policy in the 1980s further facilitated global business activities. These developments collectively allowed the U.S. to manage its debt concerns, providing an additional 40 years of economic stability. Looking ahead, if the anticipated artificial intelligence revolution unfolds as grandly as Pal predicts, there is potential for another 40 to 50 years of progress, potentially averting the pessimistic scenarios that some have been forecasting. Now, let's return to the interview.
So there are schools of thought, even coming out of Oxford University, that says we could hit a tipping point where the GDP of the planet doubles in a year or even a week. Now, that sounds extreme, but if you put infinite people or infinite productive units into the economy, you can make infinite goods. Now, who pays for the goods? Maybe the machines pay for the goods. We don't know. This is a whole new economic system being built in front of our eyes. This is something I call the exponential age, which is where all of these technologies are coming together, from energy to AI to robotics to EV to space to 5G, 6G, all of these things, biotech, all coming together, genetic sciences, to create this fastest period of technological change in all of humanity. And it's the only way out, and it's scary. When I discovered this whole understanding, both the exponential age and the everything code that came later, it was like a veil had been lifted from my eyes. Macro guys generally tended to be mean reversion guys. They look for something to get excessive, then they want to, bet against it. And they see the world like this, like the business cycle. And none of us could understand technology and why it kept going up. We kind of could understand crypto because it's like this macro phenomena of, a whole different financial system, parallel financial system, getting adoption, etc. But technology, none of us got, apart from the few. And when I started dividing everything by the central bank balance sheets to take account of debasement, I saw that technology was one of the things that just kept rising. And that led me to dig into this whole process. And that completely changed my framework of the world. I wasn't looking for the blow up now. I was looking for the melt up. And, crypto markets had taught me to use these logarithmic charts of these trends. If you look at the chart of Amazon, Apple, Google, Facebook, all of these, on a logarithmic chart, they're almost perfectly smooth trends. They're network adoption models. But when you look at them normally, they look like they go up and down a lot. Yes, they do, but within a consistent, secular, powerful trend. Once I saw that, I'm like, if our job is to make money, then this is the trend you need to be on, the secular trend, because it's driven by the central banks. It's driven by technology itself, but then also driven by the central banks debasing. So you get the double whammy from it. It's like, okay, this is perfect. And it also is the answer to the massive macro problem of excess debt and slow GDP and aging populations. So when you've got something that's so against the persistent narrative that everything's screwed and it's all going to go wrong, and you see it and do a lot of hundreds of hours of research on it, and you come up with a completely opposite view, it's like, oh my God. And then I started surfacing that view for Global Macro Investor, and then within Real Vision and elsewhere. And it was like a light bulb moment for people. They're like, oh my God, I suddenly now understand why things are happening as they are, why technology stocks keep outperforming, why crypto keeps going up, why people are angry, why politics have become so polarized. It all starts to make sense. And if we can make money from it, great.
According to Pal, there remains a significant chance to navigate the current economic challenges without severe repercussions for both Americans and individuals in countries with robust currencies. Despite this optimism, he emphasizes the continued importance of investing for anyone looking to not only preserve but also grow their wealth over time. Traditional asset classes like bonds may not rise rapidly enough to counter inflation, and popular stock indexes such as the S&P can help maintain wealth without significant growth. However, Pal contends that cryptocurrencies, along with technology stocks, stand out as the top choices for sustained outperformance compared to the depreciation of traditional currencies. In his view, only these assets can effectively counter the effects of currency devaluation. Share your thoughts on the video by leaving your comments and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.